week, we covered bank statements. I'm going to do a little pop quiz for you guys, okay? Just a few. Should be easy, but let's make this quick. What is a defaulted, for most of the lenders, what is a defaulted expense ratio they will use? The defaulted expense ratio most lenders will use in calculating the income based off bank statements. Anyone?
50%.
Oh, come on, Brenda. Yes, it's 50, but yes, I expect Brenda to know it. If Brenda didn't know it, I'd say Giving Tree's in really, really bad shape.
Okay, Brenda and I shouldn't answer any questions for today.
Using a CPA letter, okay, or using a confirmation from a CPA, what is the lowest expense ratio that the lenders will allow?
It's like 30%.
I'm disappointed. No. What is the
10.
lowest?
10%?
Who said that?
10.
Yeah, Freddie, good. But I heard a female voice.
10%, that was me.
Romy, okay,
Yeah,
good. Yes. There are lenders that will allow you to use as low as a 10% expense ratio when calculating your qualified income based off of bank statements. Okay, 10%. I would say the majority is 20 or 30. I think that's why you said that, but there are a lot of lenders that do 20 or 30. But there are lenders again that go as low as 10%. New Fire off the top of my head being one of them. Just keep in mind they are brokered. Okay. Awesome. So today, kind of to its counterpart of the bank statement program, we're going over VOEs today. Okay. It won't be long. I kind of said that last week and I went long, but this week I promise you it won't. Now, why a VOE? I'm so sorry. I am so sorry. Scratch that. A P&L. Okay, the P&L program, right? So bank statement, P&L as opposed to a bank statement program. Well, one, P&Ls in short are going to be a lot easier. Okay, because guess what? Where you will need to collect 12 months bank statements, have the team, calculate it depending on how the lender calculates it, and you'll also need a CPA letter. A P&L, all you need is just one-page P&L. Okay, do you guys all know what a P&L is and what it looks like? Yep. And if you guys have been doing mortgages for all but 2 months even, you guys have actually seen an official or a more formal P&L. Do you guys know how and why you've seen a more formal P&L? Anyone want to take a wild guess? What other document have you seen or do you see as a mortgage professional? While it doesn't say P&L on it, why am I saying that you probably have seen a P&L? You want to take a wild guess?
Are you referring to a 1099?
No, not 1099. Freddie's smiling right now because he knows, right? Anyone take a wild guess? How is it that you've already seen a P&L if you're a mortgage lender for about 2 months, maybe even a month?
Tax returns?
All right, Freddie, what is it?
Well, if you have self-employed borrowers, you probably have a Schedule C somewhere in their taxes.
There you go, guys. Tax returns. Okay, so essentially, when you've seen a Schedule C on a 1040 tax return or a 1065 partnership or an S corp or a C corp, right? 1120, 1120S tax returns. That essentially is a profit and loss, right? You have your gross income at the top line, right? How much business or earned income or revenue that business has earned. Then you have a bunch of deductions, and then you have a net profit, right? That's a P&L, simply put. So why use a P&L? A P&L because, one, tax returns obviously don't reflect the true state of a business, right? Tax returns, the P&L on a tax return, the intent there is, yes, to report the taxes, but really for what though? Right? Or what are you doing reporting the business income. You're reporting the least amount of taxable income, right? Why? Because you don't want to pay Uncle Sam. So that's why we're going into bank statement programs and now P&L. So P&L is just that. And I wanted to look at a few today, a few P&L lenders here. Most of them are non-Del actually. Because again, if you guys don't know this, and I'm still learning too, but non-Del because we can earn rebates.
Ragnar, I have a question.
Yes.
So I guess in the hierarchy of documentation quality, taxes, obviously it's like full doc. Where does bank statement and P&L rank in the order of like documentation quality? When it comes to like pricing and better terms for the lender.
Yeah, generally speaking, you'll be surprised. I'm surprised too. Generally speaking, you would think that the bank statement program would have better pricing. That is actually not the case though. So we can actually do some pricing live, but P&L programs, again, this is CPA prepared, not borrower prepared. There is borrower prepared P&L. I haven't done one. I don't. Yeah, but with borrower P&Ls, the rates are significantly higher because all it is your borrower preparing the P&L, and you can imagine why that's going to be higher, more risk, more liability there. But we are looking strictly at CPA prepared P&Ls, and you'll be surprised that the rates are the same. If worst case, it's only an eighth difference in the rate is what I've seen. And again, we're going to actually go into it. Okay, so a P&L program. We'll kind of go over it real quick, and then we'll go into why. So right, these are the names. These are the four that I looked at: AmWest, ARC, Mega, NewFi, and I have used all four, and that's why I picked them. I have personally used all of them for bank statements and P&L programs and for seconds. Obviously, you got to be self-employed. Notice there on the second row, only right now, things have changed, but only NewFi right now allow non-permanent residents. The other ones do not, right? So you guys know right now that right, FHA is not allowing, non-permanent residents to qualify. They're not allowing it anymore. Well, kind of similarly, in the non-QM world, it's affected obviously because of ICE and all the immigration issues right now where the nation's facing, but only NewFi is allowing it. Okay, all across the board, minimum FICO is the same with these four. Again, other lenders might be different. Loan amounts are pretty much the same, but NewFi does allow up to 5 million. There is a caveat to that, guys. When you get into that type of loan amount, though, do understand that there are lower DTI restrictions, lower, multiple appraisals will be needed, and so on. Again, we can look into the matrix, or you can look into it to see what those specifics are. Max LTV, guys. Right, 20% down. Just understand and know, guys, in the non-QM world, okay, when it really got nationally rolled out in 2014, I jumped on non-QM. Had I known Giving Tree sooner, I would have jumped on Giving Tree even sooner. But most non-QM guys historically, as it started, they all required 25% down payment. Okay, it was, hey, we're going to offer you these alt doc programs, but we want you to bring more skin in the game. This 20% down payment, this is more recent, right? As of I think really as of a result of the pandemic, they have become a lot more aggressive with their programs. And to that point, you see their ARC, okay? Here, let me zoom in more. ARC allows up to 85% and even 90% LTV, right? 10% down payment. Now, put an asterisk there because, yes, there are other conditions, DTI conditions, as well as the rate. Your rate is going to take a huge hit. And we can kind of look into that. into the individual matrix. This is a big one, guys. So the last two rows, I really want to focus on and spend a little bit more time. So just because it's a P&L program as opposed to the bank statement program, there are lenders then that will require, won't require any bank statements to evidence or support that P&L. But there are other lenders that will require bank statements to support that P&L. Okay. So you'll see here that NewFi and Mega do require 2 months bank statements to support the P&L. Okay. But you'll notice here, AmWest and ARC do not. Okay. So
How much higher is the pricing if you don't provide bank statements?
it's actually not that much higher. I'll show you the pricing shortly. Okay. I obviously, before I was going to present this, I had to think about how I'm going to say things here, and I still don't know how, so I'm kind of winging here, guys. Okay. When it comes to the P&L program, okay, you and we and I as loan officers, you're consulting with your client, and let's just say the bank statement program doesn't, even at 10% expense ratio with the CPA letter, okay, which, guys, don't think that's always automatic. You will get pushback from CPAs or by way of the borrower. The borrower may come back, say, hey, I talked to my CPA. There is just no way he's going to write a letter saying my expense ratio is 10%. Okay. Again, you have a lot of people that are very by the book in all professions, lawyers, doctors, mortgage professionals, right? Teachers for that matter. You have professionals that are very, very by the book. You have some that, hey, as long as it makes sense, they're willing to cut that corner. And then you have those who are just willing to go the opposite way, right? So there are different type of players, but should the bank statement, so right, the 10% may not always work, but now let's just say that the bank statement program doesn't yield you the qualifying income that your borrower wants, okay, to get that larger home price of north of $1.5–2 million, right? But they really want that. Again, this is where the P&L program can kind of come into play as to suffice that want for the borrower, okay? Because again, P&L programs, particularly the ones that don't require bank statements, you, the loan officer, you can consult your borrower on, hey, this is what it is based off your bank statements. This is what you can qualify for. Then the borrower was like, well, what kind of income do I need to provide and show on a document for me to qualify for that 1.5, that $2 million house? And you can advise them, well, based on your credit, based on the debts that appear on the credit report, we need a qualified income of, I don't know, $50,000 a month, let's say. He's like, well, I'm at 42 per bank statements using an aggressive 10% expense ratio. I said, okay, well, look, to get to 50 on let's just use 20% expense ratio, just to be a little bit more conservative. We will need to see, we can look at another program. It's called the P&L program. And if or should you talk to your CPA and your gross income was X amount and you had these deductions, 10% or 20%, and the net income is this 50,000, then we can get a deal done. So borrower's like, really? This is what we need to see. Okay. Let me talk to my CPA. Okay. You loan officer. Okay, I'm talking to you. Yes, loan officer. Alex, Freddie, on, Red, Peter, C. You're not telling them, hey, go tell your CPA to give me these numbers. Okay. Be more passive about it. if your CPA can support
Comment,
these
can I
numbers on
comment?
a P&A, what's that, Freddie?
Can I comment something real
Yes,
quick?
please. Go for it.
Yeah, I think I know where you're trying to get with this. What I
No.
would say to a borrower, I would say I wouldn't use your income needs to be here or you need to be here. I would say for a borrower looking for a loan amount of X amount of dollars,
Very good.
the income needs to be here with an expense ratio of this, and they most likely are going to have to show 2 months bank statement or show them the other option. I wouldn't necessarily customize it to their scenario, but I would say for somebody looking for a loan like this.
Very good. Very good. I appreciate that. Very good. You guys understand the little tweak that Freddie did there? I was just putting, when I said you, the borrower, I was putting a little bit more emphasis on the borrower. Whereas, Freddie's taking the approach of just a generalization, just to present the loan itself, the loan scenario itself that the borrower wants. Okay. So well said, Freddie. And yeah, if the borrower's CPA can furnish that P&L, then you, the loan officer, is going to work off that P&L provided by the CPA. You guys have any questions there? Like I said, I preface this by saying that things can operate in the gray here, okay? But your job is to work off the documentation that's provided by these professionals, by the CPA, okay, which we're going to further kind of go into. So the last one, okay? Every lender, this is imperative. I mean, so important here, okay? You guys can go in and get excited, and borrower is willing to do whatever they want through a P&L program. You price it out. You offer the best rate. Well, you got to be careful. Again, we're going to go through this practice soon after this. But notice here that even amongst these 4 lenders, okay, there are different requirements by that preparing or by the preparer of that P&L. Okay, so with AmWest, okay, they tend to be a little bit more loose. Okay, they allow CTECs, EAs, and CPAs, not just CPAs, but they allow the others. However, they have to state that they prepared the borrower's tax returns the past 2 years, their business tax returns past 2 years. So borrower comes, gets excited, says, yeah, my CPA is willing to do it. Prepare a CPA, P&L that nets this type of income for us to qualify for this purchase price. Submits it. You guys send it into underwriting. Underwriter reviews it. Underwriter is going to condition for a CPA letter. It's basically a confirmation letter. Okay, it's a confirmation letter from the CPA, and part of that verbiage has to entail that they prepared and handled the tax returns, the last 2 years tax returns. Okay. Now, I'm sorry. Here it says handled. What does that mean? I don't know. Okay. This is straight from the matrix, but it says handle the last 2 years tax return. So I got this. I'm getting this confused because there are other lenders. Here it is, CPA or AmWest. I'm sorry, my goodness, Mega Capital. Mega Capital says that they prepared the borrower's tax returns. Here they're saying handled. Handled could mean, the CPA to the CPA. It could mean that they saw the borrower provided tax returns, prior business tax returns, and the CPA saw it and looked at it, reviewed it. He handled them. Doesn't necessarily mean that they prepared it. Okay. You will notice that here with Arcom, all it says is that they just have a relationship. Okay. So this one's a little bit more aggressive, or not aggressive, but lenient. It says we have a working relationship. Okay. And look at this one here, NewFi. It doesn't talk about relationship or preparing. They just want to know that the CPA has seen the gross receipts of that said business, borrower's business. Okay. You guys all catch that? My point in this is it's so important for you guys to go into the matrix. And that's not just with P&Ls, that's with any non-QM product. Okay. So if those who are not on this call, Hannah, Christine, C, and for those Ian, and for those who are here, it is so important that you guys, when it comes to non-QM loans, after you price it out, you look into the matrix and run it through. Okay. So we're gonna do any questions before I step away from this comparison chart. You guys kind of get an idea though that there's 4 lenders that offer this program. There's some similarities here up top, but when you get into the nitty-gritty of things, the things that really matter, right? As I would say, and I would point out, there's some differences. Okay, so we're gonna quickly go into